Beneath the surface of every sustained bull run lies an invisible architecture built on borrowed money. When asset prices climb day after day, the temptation to amplify gains becomes nearly irresistible, drawing capital into a structure that feels entirely solid. Yet, this architecture is inherently fragile, bound by mathematical triggers that remain dormant until volatility strikes. Borrowing capital to purchase assets, known as buying on margin, allows an investor to control a larger position than their cash alone would permit. If a portfolio holds $100,000, a broker might extend another $100,000, doubling the exposure. When the chosen assets appreciate, the returns are magnified, creating a powerful wealth-building engine. But leverage is a symmetrical force. If those same assets decline in value, the losses are equally amplified, and the broker holding the collateral demands protection. This demand arrives as a margin call, a strict requirement to immediately deposit more cash or sell off holdings to restore the account minimum equity threshold. In isolation, a single liquidated portfolio barely registers in the broader financial ecosystem. The specific, often hidden danger emerges when countless participants have simultaneously engaged in the exact same borrowing behavior. A minor, localized market correction can suddenly trigger a synchronized wave of these demands across an entire sector. As investors rush to sell assets to meet their broker requirements, the sudden influx of supply drives prices down even further. This subsequent price drop triggers a second, deeper layer of demands for more collateral. The mechanics of margin calls act as an automated feedback loop, turning a natural market dip into a mechanical plunge. This exact dynamic fundamentally reshaped the global economy during the 1929 stock market crash. Throughout the late 1920s, speculative fervor drove retail investors to buy shares with as little as 10% down, borrowing the remaining 90%. The market seemed invincible, fueled by this unprecedented credit expansion. When the tide finally turned in October 1929, brokers issued demands for cash that their clients simply did not possess. The resulting forced liquidations flooded the ticker tapes with sell orders, overwhelming the exchanges and erasing fortunes in a matter of hours. The sheer volume of automated selling transformed a severe correction into a generational collapse. The memory of that era eventually led to stricter regulations, yet the underlying appetite for amplified returns never truly vanished. Financial innovation simply shifted the borrowing from retail brokerage accounts to complex institutional instruments. Wall Street developed new, sophisticated methods to stretch capital, moving the risk off the traditional balance sheet. Institutional leverage operates through derivatives, repurchase agreements, and prime brokerage relationships. A hedge fund might use its existing treasury bonds as collateral to borrow cash, buy more bonds, and repeat the process multiple times. This operational leverage extracts yield from tiny price discrepancies, but it requires immense scale to be profitable. The 2008 financial crisis demonstrated the devastating potential of these institutional structures. Major banks and investment firms were heavily leveraged against mortgage-backed securities, treating them as pristine collateral. When the underlying housing market began to fracture, the perceived value of that collateral plummeted overnight. Lenders immediately demanded more capital to back the loans, initiating systemic margin calls across the global banking sector. Because the toxic assets were illiquid, institutions were forced to sell their high-quality assets just to raise cash. This indiscriminate selling pressure drained liquidity from entirely unrelated markets, proving that institutional leverage serves as a primary transmission mechanism for financial contagion. Uncovering the true extent of this borrowed capital is notoriously difficult because modern financial instruments are intentionally opaque. Even the regulators who monitor systemic stability often lack a complete real-time picture of who owes what to whom. This lack of transparency means that the catalysts for the next liquidity crisis are usually hidden in plain sight. The collapse of Archegos Capital Management in 2021 serves as a stark warning about the evolution of these complex mechanics. Operating as a family office, the firm utilized total return swaps to amass staggering positions in a handful of media and technology companies. By using swaps, the firm gained the financial exposure of owning the stock without actually holding the underlying shares. More importantly, These derivative contracts allowed the firm to bypass standard reporting requirements, masking their massive footprint from the broader financial system. They secured extreme leverage from multiple prime brokers simultaneously, none of whom realized the full extent of the firm's concentrated bets. The structure was an architectural marvel of risk, perfectly calibrated for a rising trend. When a few of those concentrated positions experienced a routine downturn, the prime brokers issued their demands for collateral. Unable to meet the billions of dollars required, the firm defaulted, leaving the banks to violently unwind the massive swap positions. The resulting block trades vaporized $20 billion of wealth in a matter of days, sending shockwaves through the equities sector. These events illustrate that major market crashes are rarely caused by a single piece of bad economic news. Instead, the news merely serves as the spark that ignites the highly combustible fuel of excessive borrowing. The accelerators of the decline are always the automated forced liquidations that strip human emotion and fundamental valuation out of the pricing equation. For the modern investor, understanding this dynamic is essential for long-term wealth preservation. Recognizing the signs of systemic over-leverage allows for more prudent portfolio construction and risk mitigation. It shifts the focus from trying to predict the exact top of an index to preparing for the inevitable mathematical unwinding that follows. High levels of margin debt across the New York Stock Exchange historically correlate with peak financial exuberance. While this data point alone cannot predict a crash, it serves as a reliable gauge of the system's potential kinetic energy. When aggregate borrowing reaches historic highs, the probability of severe cascading corrections increases substantially. Strategic asset allocation must account for these liquidity vacuums. Holding a portion of a portfolio in cash or highly liquid, low-correlation assets provides a buffer against the indiscriminate selling that characterizes a margin-driven panic. This dry powder becomes exceptionally valuable when forced liquidations drive the prices of fundamentally strong companies down to irrational levels. It is also crucial to evaluate the operational leverage of the companies within a portfolio. Businesses with high debt burdens and tight cash flows are uniquely vulnerable when credit markets freeze during a liquidity crisis. Conversely, companies with fortress balance sheets can navigate the storm and often acquire distressed competitors at steep discounts. Financial history guarantees very little, but it strongly suggests that the cycle of credit expansion and subsequent contraction is a permanent feature of human economies. The specific instruments of leverage will continue to evolve, growing more complex and harder to track. Yet, the underlying mathematical reality of borrowed money remains absolute and unforgiving. As global markets become increasingly interconnected, the speed at which these unwinding events occur will likely accelerate. Algorithmic trading and automated risk management systems react to collateral shortfalls in milliseconds, compressing what used to be weeks of selling pressure into single trading sessions. The modern financial landscape requires an equally disciplined and systematic approach to risk. Navigating this landscape demands a shift from seeking maximum potential returns to optimizing risk-adjusted performance. The allure of amplified gains must always be weighed against the catastrophic potential of forced liquidation. True strategic advantage belongs to those who understand the invisible forces shaping the economy and position themselves to survive the inevitable mathematical reckoning.